Welcome to the Group Dentistry Now show, the voice of the DSO industry. Join us as we talk with industry leaders about their challenges, successes, and the future of group dentistry. With over 200 episodes and listeners in over 100 countries, we're proud to be ranked the #1 DSO podcast. For the latest DSO news, analysis, and events, and to subscribe to our DSO weekly e-newsletter, visit groupdentistrynow.com. We hope you enjoyed today's show.
Welcome, everyone, to the Group Dentistry Now show. Happy 2026. I'm Bill Newman, and we really appreciate you all checking in with us. Always have great guests, and I'm surprised we haven't had AJ Peak on the podcast before. Shame on us, but we've got him on now. So it's great to have you with us, AJ, and happy 2026.
Thank you for having me. Looking forward to it.
So probably a lot of you know AJ, but there might be some that don't. So AJ was the founder of Peak Dental Services, and he probably doesn't remember this, but I met AJ at the Henry Schein DSO event in Las Vegas. Probably in 2017 or 2018. And actually had a chance to meet his mom and dad. They were there as well. In fact, I think his mom and dad were like the first people there scouting out the event. And AJ came in a little bit later, but kind of got to meet the whole family. So that it was a nice memory. And AJ scaled up Peak Dental Services and took it from a single practice. Was that your dad's single practice? Did you start with that?
It was. It's just him and 4 employees.
Yeah, to over 50 locations, 100 million in revenue. So just a neat story and fun memories of meeting your dad and mom. And congratulations on what you built there. But now you've moved on to something else. You're the founder and CEO at Health Wealth Capital. So maybe take us through, your single practice to, getting to that 50 plus locations at Peak, and then you're transitioning off to Health Wealth Capital.
Well, thanks, Bill. It was a nostalgic memory at 17, 18 presenting at that conference. As I was acquiring and building dental offices, occasionally the dentist would own the real estate. This started several years ago. And in order for them to sell the practice, they needed to sell the real estate. Often the debt was cross-collateralized. And so several years ago, set up kind of friends and family fund and a separate entity to buy the real estate and then lease it back to Peak Dental Services. So that was sort of my experience in dental real estate starting several years ago. And it was a lucrative side investment for quite some time until about 2 years ago started the beginnings of building a real fund of Health Wealth Capital, where raising syndicated capital to essentially buy triple net lease dental real estate, sometimes veterinarian and some other healthcare real estate, where basically scaling up what I was doing in a small capacity across the country to buy kind of medical real estate, predominantly dental.
Maybe we start with some terms that some people might not be familiar with. So sale-leaseback, maybe define what that means.
So many healthcare entrepreneurs, particularly your audience, DSO executives or starting dental entrepreneurs, if they own their building and they own the practice and they're looking to grow, this has been a successful strategy for many. In fact, I know of some that have grown 10, 20 locations last year through the term sales-leasebacks. So they buy the real estate and they buy the practice. They'll go to an institutional investor like our fund and agree to a 10, 15-year lease, typically a triple net lease. And in exchange, we'll often pay a premium for that real estate, oftentimes hundreds of thousands of dollars more than they bought it, even if they bought it recently within a month. So by converting that building that they now purchase from maybe a solo dentist, and they purchase the practice, and they turn around and offer an institutional investor a 10 or a 15-year triple net lease. That's called a sales leaseback. They're going to now sell the building in exchange for the lease, and they may have bought that building for, let's say, $600,000, and we'll turn around and hypothetically buy for $1.2 million. And in exchange, they made $600,000 in a short period of time, and they're able to go invest that capital, and oftentimes to buy additional practices and additional sales leaseback kind of real estate. And sort of some dental groups have done this 10, 20 times in a year.
And is it pretty commonplace now that you see the sales leaseback? I mean, is it becoming more commonplace?
It's becoming more commonplace to some. Had I known about this strategy when I was building my DSO, I would have borrowed maybe half as less money as I did. So it's not a technique that I knew about 10 years ago when I was growing and scaling. I was borrowing tons of money from a bank. And I think with the banks kind of retracting with interest rates rising the last few years, there's been some really entrepreneurial dental groups. You see this heavily in urgent care, and some of that same tactics has now come to dental and veterinarian, where they've been able to find, dental practices for sale. They're growing, they're multi-site. The dentist owns the building, and they sort of own the practice in the building, and they sell the building for, comparable, dollars per square foot basis, maybe 700,000. And they know if they put in place a triple net lease with an institutional investor like us, we'll pay a premium, oftentimes, sometimes double what they paid. And that can be their sole source of financing. I know of a couple dental groups that have no bank financing, and through sales leasebacks are funding all their growth. So I'd say it's not common knowledge, but growing substantially. And I'd argue some of the fastest growing DSOs last year were growing via this source of capital.
Excellent. So you use the term triple net lease. So can you explain what that means?
I think I signed 10 of these things as a tenant before I really understood what they meant. So it's not well understood, but it is all taxes, all insurance, and all maintenance expenses. So that's the three items that the tenant is responsible for. And in the audience, if you look at kind of any retail center, majority of the dental practices, if you were to drive on a busy street corner, you see a dental office, they are probably 90% in what's called a triple net lease, meaning they're paying the rent, any of the property taxes, all the insurance, and all the maintenance on that building. And it's sort of the, for investors, gold standard to have a triple net lease. You're really not exposed to inflation. It's all in the tenant. And so, a real estate investor, that's, worth a lot, meaning the tenant's really almost self-managing the property for the most part. Outside of maybe the roof and the walls, the tenant is really responsible for everything.
So as we kind of look at the two different, because you've really got two different things going on. You've got in a lot of cases, you've got the value of the practice itself, and then you've got the real estate valuation. A lot of times, I think in an entrepreneur's mind, they combine the two, right? So there's
right.
Maybe talk through that a little bit, because I think bigger investors, bigger platforms are looking at the value of the practice and not so much the value of the real estate. But maybe talk through that little bit of a disconnect.
And it's not well understood. Until most recently, I don't think I really got it. As to how important the real estate can be from a total valuation perspective. And if in the audience, if there's an entrepreneur and they own, let's say 5, 10 buildings, and they've got, 10, 15 locations on that front, the deciding factor is really how to handle these leases and how to sell that real estate before you go to sell the practice. And I'd say 95% of the time in this industry, that does not happen. We all, and including myself, we've sort of fixated on the practice, and real estate is sort of handled in the 11th hour, and oftentimes at the detriment of the total valuation. And if you learn certain tactics on a per practice basis, the combined value of the practice and the real estate can actually go up by upwards of $500,000 in almost every scenario, $100,000 if you sort of structure it properly, not in the 11th hour. And the proper way to do it is to actually engage in a sales leaseback or put the property in a traditional triple net lease well before you go to sell the practices. And if you do so, you can mathematically engineer the valuation of the real estate. So the real estate being valued on a triple net lease basis is going to add value, number one. And number two, if you pay higher rent, you have less EBITDA. And most of your listeners will understand, dental practices, DSO, are valued off of EBITDA. And so if you pay more rent, you're thinking, I don't want to pay more rent because my EBITDA is going to go down. Well, to be honest with you, the average multiple on your dental real estate under a legitimate triple net lease is going to be around 12x. And unless you're one of the top 3 DSOs in the country right now, you're probably not getting a 12x valuation on your dental group. Maybe you're getting a 7 or X multiple on your dental group. Oftentimes, if you're smaller, even less. So on the real estate, there's a premium valuation to at least bring the rents up to market levels and on the tippy top of market levels. And that's where you get an arbitrage, where you get a slightly higher valuation on the rental rate for the real estate than the lost or foregone EBITDA on the rent being a little higher for your practice. And so you can actually do the math. It's algebra. And almost every time it's about 100,000 per practice, upwards of $500,000. And I know of at least 5 people last year that they got to me too late and lost over $500,000 in valuation on the combined practice sale and practice sale because they waited till the 11th hour, and they were being bought by a DSO, and the DSO kind of negotiated maybe a little harder on the lease than they would have had they handled that beforehand, and they really agreed to something that was not a triple net lease and therefore destroyed a ton of value. The other part to your question, Bill, is if you're a DSO, this can actually, be really strategic for you. You can find a dental building where the dentist is selling the practice in the building, and you may not have a mandate to own real estate. I know Peak Dental Services, our mandate was not to own real estate on the balance sheet, but you can still put that under contract. And that, hey, if I agree to a long-term triple net lease in that space, there's buyers out there, Health Wealth Capital being one of them, that may pay a multiple of what you're paying for that building. So you might have that building under contract for $600,000. We'll turn around and, put an offer together and buy it for 1.2, and you will never have to put up the cash, meaning you'll assign that over to us. We close and you get the spread or the arbitrage. Some dental groups, that arbitrage might be 200,000 to upwards of $1 million. With some of the buyers and sellers I interacted with last year, that could be transformational for your DSO. Almost fully fund the practice purchase if you know what you're doing and find the right opportunity.
I think one of the really exciting things about these sales leasebacks is the ability to fund acquisitions and de novos. And we talked to, when we first met, money was cheap, right? So it wasn't as big an issue as it is now. It's a different story if you can get a bank to even lend to you. So this is a really great solution. Do you want to? And you're advising DSOs and emerging groups on this right now. So maybe kind of take us through, how that all works.
And so the question being how to finance the acquisition practice through
exactly right.
And basically, there's 2 ways to evaluate commercial real estate. The sort of lowest common denominator way is you look at comparables of dollars per square feet, and it's not unusual that a dental practice is considered to be like office space, and without a lease, it's going to go on a dollars per square foot basis. So it's very common that you might run into a building in, Tucson, Arizona, or somewhere in Knoxville, Tennessee, where the building is only worth $500,000. And the dental practice is, you might be buying it for, let's say, $750,000. Maybe it's a smaller $1 million practice, and you as a DSO are going to buy the practice for $750,000, and you get the building. The dentist is not, looking to own the building post purchased. You get the building agreed to for $500,000. If you were to, pay for that, and I can sort of do quick math on my head, roughly agree to $80,000 in rent a year, which is not that much for $1 million practice. Maybe the practice is doing $1.5 million, something in that zone, and you agree to a 10 or 12-year lease. In most markets, we're going to now turn around and offer $1 million or $1.1 million for that building. Now, if you get it even better, you'll never have to buy the real estate. Some people will. I don't, encourage that, because why put up the cash? You can just get it under contract or under letter of intent, come to an institutional buyer like us or some other groups out there. We'll quickly be able to do the math, usually within a day or two, offer you $1.1 million. We then step in to your shoes as the buyer. And at closing, we're going to fund the difference between what you had it under contract for, let's say $500,000, and in this scenario, 1.1. So minus some transaction fees and taxes, you still cleared net of $500,000. And the practice, let's say, was under purchase for $750,000. Nearly every DSO out there, you're agreeing to sort of cash and some equity rollover. Likely, the cash that you promised the seller was less than the $500,000 you got. So you might actually put money in your pocket, working capital, through a typical cash and equity rollover. It just creates a positive flywheel for growth to fund your acquisitions of practices. And there's some DSOs that have really figured this out. And that's the only type of acquisitions they're doing right now, where they're actually looking for dentists that own the building, own the practice, and they kind of understand the valuations of triple net leases, and they'll find buyers like us to step into to buy that real estate and pay them that kind of arbitrage.
So in today's environment, how should a DSO think about? So you may have access to traditional, bank debt, right? You've got some funding versus real estate capital, and then I guess, are there constraints on that debt from just like the speed of acquisition? Because we have seen things really slow down with some groups.
Yeah.
Or completely stopped when it's come to acquisitions or de novos. And then you talked about other groups that it seems like they've been funding a lot or all of their acquisitions or de novos with sales-leasebacks.
Yep. Some bank financing, before interest rates, skyrocketed and money was cheap, banks were going for, traditional banks would go up 4.5 times debt to EBITDA. Non-traditional banks would go 6, 7, 8 times. And when money was cheap, you could almost always buy a practice, let's say at a 6x multiple, and you have 30% equity rollover. The bank was going to borrow 4x to you, kind of 100% of the time you could do it with no cash, meaning you're sort of just using 100% borrowed proceeds. And I would say you could do it unlimited, but you could do it at a pretty aggressive pace with bank financing. In today's world, that's really, I don't want to say dried up exclusively, but it is not as easy as to source debt as it once was. You're probably going to be limited to something like 3 times EBITDA. And, that puts more pressure for you to come with more cash to the table to do acquisitions. In sales-leasebacks, essentially it's off balance sheet. There is under GAAP reporting, some of this is sort of contingent liabilities, and won't get into it, but from a bank financing standpoint, it's not really traditional debt. And oftentimes these don't have personal guarantees. So I know until I was private equity backed, I had millions of dollars in personal guarantees. With sales-leasebacks, if you've got a really substantive dental group, a lot of these sort of long-term leases won't have personal guarantees. They'll have corporate guarantees, but not personal guarantees. So you're winning there with not having personal guarantees too. The balance sheet treatment's a little differently. It's not treated as traditional debt from a lot of others' perspectives. And so when you go to get a transaction, if you grew your DSO through sales leasebacks, that's not treated as debt. These leases aren't treated as debt. When I had 50 practices and did a private equity transaction, they weren't valuing all these leases and then taking it off the enterprise value. Now they did take off enterprise value debt, right? So just for your audience, let's say enterprise value is $100 million. If you've got 50 million in debt, then your net equity is only 50. But let's say you grew your DSO 100% through sales leasebacks, and your $100 million of enterprise value, you're not going to have that subtraction math, meaning there's no debt. So it's pretty incredible. Not only does it help fund your growth, but it doesn't hit you in terms of debt on your valuation. Now, there are some caveats. The sales leaseback, the lease terms have to be in market rate terms. You can't agree to a lease at, let's say, $40 a square foot if the local market rent's $18 a square foot. So it's got to be, economically within the market, can bear, not some arbitrary high lease. But if it's within the market, you do this, appropriately, that is not going to hurt your valuation when you go to exit. So the sales leaseback's not only been a solution for more favorable capital, but when you go to exit, it's not going to ding you, reduce off your enterprise value in terms of your valuation. It's, had I known this, I would have done this almost exclusively 10 years ago in growing Peak Dental Services.
Well, I think with that, I'm sure there's some groups in our audience, if they're looking, maybe they've got like a 3 to 5 year horizon, maybe some advice for them. What should they be, doing with their real estate, and how is that going to influence, the exit valuation, the deal structure, and just the leverage that they have. So now somebody's 3 to 5 years out. Now's the time to start looking at things.
So if you're a dental group and you've got 5, 10, 20 locations, and some of them you own and some of them you lease, the ones you own, 3 to 5 years out, if you're going to continue to grow, I would heavily consider, at least half your growth, the majority of it doing through sales leasebacks, this sort of strategy I mentioned. You've got to be more selective as the opportunities you go after, but I highly recommend it. It can be, transformational in terms of what you stand to make at exit. So that's number one in terms of future growth. Second is really get in place now, even with yourself. Let's say you own the real estate in some other, random legal entity you set up and you own the practice. At a minimum, get a traditional market standard triple net lease in place, and don't hire your local favorite attorney. Hire an attorney that's doing a dozen of these a week. This is a highly specialized category, triple net leases. And although many attorneys might do 4, 5, 10 of these a year, that is not what I consider to be a specialist. Somebody that almost exclusively is doing, 5 or more of these a week is who you want to talk to, because the land of triple net leases, you can have somebody say there's a triple net lease and it's 2 pages long, and another one is 50 pages. And, truthfully, you want the bigger triple net lease, because institutional investors like us are going to value that at a premium. And so if you have that in place, even when you own both assets, when you go to exit, the future buyers are going to just take it for, as a given that you've got a triple net lease in place, and it's not really up for negotiation. And you're going to want to have that triple net lease in place for at least 10 years or more at the time of selling. So what I would do is actually put it in place right now for 15, because you're going to exit in 3, and then you just tell your future buyers, like, this is what it is. This is the market standard triple net lease. There's another 12 years left on it. That's going to maximize the value of your real estate as well as your practices when you have that in place when you go to transact.
Why do you, as an institutional investor and others, see triple net leases as so attractive?
When I raise capital for our investors and you compare that to other real estate categories, let's say apartment buildings have been proliferated everywhere in high growth areas in this country. With apartment buildings, you have what's called a gross lease with tenants, meaning they pay you just a fixed rate. But if your property taxes go up, which they have, or insurance they have, particularly in coastal areas, you don't have a way to immediately pass those expenses on to your tenants. You got to hope and pray you can raise rents. Now, if a competitor put up an apartment complex across the street, you can't raise rents because it's competition. And so that eats into your investor returns. In triple net leases, it's like having a bond. Like you're getting almost a guaranteed payment because there's guaranteed negotiated rent increases. Plus, the triple net lease covers all those expenses. So if inflation happens, whatever happens with property taxes, insurance, as long as the tenant, in our cases, dental practices or veterinarians, are high performing, they're going to have to absorb all of those inflationary costs. And so as a real estate investors, for us and my investors, it's really security in the investment, meaning we can own this with high degree of predictability. We kind of know what our investor returns are, what our distributions are going to be. And so that's just a premium asset in terms of predictability in the finance world.
So this is the mistake question. Since you've got a lot of experience, you were at Peak, you're working with a lot of DSOs now, and especially when it comes to scaling, are there some mistakes that you see, or some things maybe that people in the audience can avoid when you're scaling from maybe that? We see those inflection points, right? We see, that like the 5 to 10 location inflection point, and there's like that 25 to 50. There's all these different areas where, we see a lot of, almost groups go backward, right? They were doing better when they had fewer locations. So maybe any tips on that? And somehow I know this is going to tie into real estate, but from that 25 to 50 in particular, I think we've got a lot in the audience that are there at that inflection point.
For me, it felt like in multiples of 10 or 15 locations, things just fell apart. And the way that I did them before just would no longer work, up to about 50. And I'd say at 50, it really changed. But going from 10 to 20, 20 to 30 on up, it really got challenging. And you start to kind of drink your own Kool-Aid that you had such great success with 10, you're just going to keep running this, forever. And I think one of the things that for me was sort of basic and being quite analytical and oriented was just having the right dashboard of KPIs. And I thought I did understand the numbers. And the problem is I had too many numbers. And so I was always looking at everything. And with 10 locations, I could almost memorize every KPI. If you had asked me, I kind of knew off the top of my head. It got to 20, 30 locations, really starting to simplify and understanding those key drivers. I didn't do it soon enough. I did it far too late and started narrowing in on what are the top 10 KPIs to be able to manage the business so you can kind of see around corners a lot quicker. Your 10 locations, you kind of intuition, you're an entrepreneur, you kind of see everything. When you get to 20 locations, that visibility, your ability to understand all those KPIs kind of goes out the window. And so really nailing down the top 10, I think was just a common mistake many people make. And often you don't realize it until, you're financially already in the struggle bus, if you will, and you're trying to figure things out. I'd say the second for me was kind of hiring ahead of schedule. I often was sort of, hey, I can do this, or I can pick this up, or, I'll work a little bit more and do those things. And, it's a people-driven business. And I think the thing that I always took for granted that even if you run a high-performing 10 locations, when it's 20 locations, and if they're all high-performing, random things happen. And so it's law of large numbers, just death, disability, in Colorado, a doctor would break their arm. The incidence of these random things just goes up because you're bigger. And when you're bigger and those random things happen at you, you need an infrastructure of people to handle that. And I think I learned that far too late, where I'd sort of had the right team in place or even some of the right things to handle. Otherwise, what I found out, I was just putting out fires all week and couldn't do the things I was doing when we were smaller to grow the business because I was just handling all these random kind of fire drills. Not that anything was materially wrong. It's a people-driven business. weird things happen. And so they would take time and attention. And if you don't have a senior team, that was a really challenging thing in my early inflection point. And with the DSOs I help grow now, often see, they're at 20 locations and they're just drowning in all these sort of random idiosyncratic events that are natural, but they don't really have a team to handle them. And so they don't have the time and energy now to grow the business.
Yeah, I think those are some really valid points. And I've heard that, especially your second point there with hiring early. I hear that time and time again, and I think that is probably something that's pretty consistent with entrepreneurs, right? You think you can do everything, and then you find out too late that, gosh, I needed to put somebody in place 6 months ago to handle this. So put you kind of behind the 8 ball, right? It slows your growth.
Right.
So I think that hiring early and on the KPI side of things, definitely noted. Can you kick out a couple of like the top KPIs that you were measuring at peak that you think people should be measuring at their DSOs?
I think for us, we're a provider-based business, and this sounds so simple, and you'd think I understood this sooner than I did. But provider days, if you don't have a provider working, that's how we make money. So provider days, kind of visits per day and dollars per day, those sort of three kind of would be three right out of the gates kind of understanding. And I intuitively knew it, but I didn't track it, measure it quite at the level I should have at kind of 10 to 20 locations. And what would happen to me is, when you get, or if even there's a snow day, well, that would knock out your doctor days. And so you could then understand, what's happening, or, more doctors take off time. And all of a sudden you had your doctors take 10% of the time off than they did the previous year. It's really hard to grow same store sales if your doctor days shrink by 10%. Visits per day, that's something it sort of, you really can get to an industry standard of 12 visits per day. If you're, I think a good dentist, some can get as high as 18 or 20. But if you're struggling at 6 or 8, it's quite a big deal. If you can get from 8 to 12, you're going to almost grow your production 50%. And that can actually just help you figure out the levers for growth very quickly. On the visits per day, doctor days, and the dollars per day are kind of the three big core ones that I encourage everybody to measure and really get your arms around when you're smaller. And it's going to help you manage the business when you get larger.
Thanks for that. Okay, so we're beginning at 2026. So what does your crystal ball say as far as what does the DSO industry look like for the rest of this year? And then talk a little bit about what you're doing in the new year at Health Wealth Capital.
I'd say as the DSO industry, speaking conferences, I'm on certainly the board of Peak Dental Services and advise with a half a dozen DSOs. I think the industry is growing impatient. We've been sort of in the coal mine of high interest rates, high inflation. You have a lot of dental groups that are looking to transact. And I think finally you're starting to see some relief on interest rates. And I think more kind of positive enthusiasm for some transactions to happen. I don't think it's going to be the boom times, but I think you'll start to see some more groups transact, maybe not at the, favorable multiples that were in 2020, but at least getting some reasonable transactions happening this year. And I also, I think it's going to happen, if not this year or next. You'll start to see some mergers of equals. There's just an awful lot of groups of similar size and looking for that next level of growth. And so I think one way to get a growth is if you have two kind of management teams and infrastructure and of equal size, that's one way to get kind of an earnings arbitrage, if you will, in sort of arbitrage benefit just from economies of scale. So, would be interested to see some groups kind of mergers of equals this year to kind of get a better outcome, if you will, from an EBITDA exit standpoint. From Health Web Capital, we are about 100 million of assets under management. We've been added about 30 buildings this last year. And if you look at the fourth quarter, we're looking really just to run rate into the new year, what we did in the fourth quarter, which would enable us, believe it or not, almost to add another 100 million of assets next year. So we're sort of adding almost 25 million a quarter. It's roughly, 10, it's about 15 locations every 90 days. So we're doing 1 to 2 closings a week. Presently in 25 states. We're pretty open to be in any of the 50 states without the country. So just kind of doing this at a farther 2x the pace we did in 2025, adding predominantly dental buildings, sometimes veterinary buildings throughout the country. Roughly 50, 60 buildings would be the goal next year.
So if there's anybody in the audience that would like to learn more or reach out to you, AJ, because there's a couple of options, right? I mean, there's the opportunity to potentially invest, right, and with your organization, but then also as a DSO or a dental group to just learn more about from you, like, hey, this is what our real estate portfolio looks like. Can you help us with strategy? And so talk a little bit about best ways to connect with you and work with you and your organization.
Best way is just shoot me an email. Pretty personable. It's AJ@healthwealth, one word, .capital. You can also check us out online at healthwealth.capital, our website. But welcome to send me an email, just letter A to letter J at healthwealth.capital. Certainly welcome to connect with me on LinkedIn as well. And happy to set up time and see if I can be helpful.
Excellent. Well, thanks so much, AJ. And thanks everybody for listening in or watching the podcast. Again, happy 2026. And until next time, this is the Group Dentistry Now Show.
Thank you for joining us today. Don't forget to subscribe to the podcast to stay up to date on the latest DSO news, insights, and events. Also, subscribe to our DSO weekly e-newsletter at groupdentistrynow.com.